Okay, welcome everyone to the London School of Economics and Political Science for tonight's public event, public lecture. My name is Martin Oehmke. I'm a professor of finance and I'm also program director for financial risk and regulation at the FMG, the Financial Markets Group. And it's a real pleasure to welcome everybody here tonight for this event at the Old Theatre. I want to start just with a little bit of boring housekeeping, but important, but just bear with me for a couple of minutes. Mobile phones, please make sure they're off or on silent. If you use X, you post on X, then there's a hashtag for today's event. It's hashtag LSE Goodhart. The event's being recorded, and we will, subject to hopefully not, but any technical difficulties, but if we don't have them, we will make the video available on the FMG website as soon as we can. There's also a photographer in the room to capture this event, and then a selection of those photos we will also post on the website. If for any reasons you do not want your image to be published, then just let us know after the event and we'll make sure that that's going to be the case. Fire alarm, none are planned, so if there is a fire alarm, please all calmly leave the building via the fire exits and then follow the instructions of the staff and stewards. And then after the lecture, there will be, as usual, a chance for you to ask questions. There's going to be a Q&A, and I will, after the lecture, talk a little bit more about how we will handle that. But we'll open the floor for questions then and not during the lecture. Okay, tonight we're all here and we're delighted to be hosting the 5th annual lecture in honor of Charles Goodhart. Charles is here. Charles, as you probably know, is an eminent economist who was appointed to the Norman Sosnow Chair of Banking and Finance at the London School of Economics in 1985 until his retirement in 2002, when he became Emeritus Professor of Banking and Finance. He was elected a Fellow of the British Academy in 1990 and awarded the CBE in 1997 for services to monetary economics. In 1986, so anniversary coming up here, he helped establish the Financial Markets Group, the FMG, at LSE. And for the prior 17 years, he served as a monetary economist at the Bank of England, becoming chief advisor in 1980. Following his advice on overcoming the financial crisis in Hong Kong in 1983, he subsequently served on the Hong Kong Exchange Fund Advisory Committee until 1997. That same year, he was appointed one of the 4 independent outside members of the newly formed Bank of England Monetary Policy Committee. He became an economic consultant to Morgan Stanley in 2009 until he resigned at the age of 80 in 2016. Charles has written widely on matters relating to monetary policy, especially central banking and macroeconomics, and he is famously the author of Goodhart's Law, which states that any observed statistical regularity will tend to collapse once pressure is placed upon it for control purposes. Now it's my absolute pleasure to introduce today's speaker, Isabel Schnabel, who will deliver the lecture tonight. Isabel Schnabel has been a member of the Executive Board of the European Central Bank since 2020, where she is responsible for market operations, research, and statistics. She's currently on leave from the University of Bonn, my hometown, coincidentally, where she's been a professor of financial economics since 2015. From 2014 to 2019, she served as a member of the German Council of Economic Experts. She also served as co-chair of the Franco-German Council of Economic Experts and vice chair of the Advisory Scientific Committee of the European Systemic Risk Board. Isabel Schnabel studied economics at the University of Mannheim, Paris, Sorbonne, and Berkeley. She holds a PhD in economics from the University of Mannheim, and her research focuses on financial stability, banking regulation, central banking, international capital flows, and economic history. This evening, Isabel will be speaking to us about the quiet erosion of central bank independence. So let's give Isabel a hand and welcome her to the podium.
Dear Charles, dear Martin, dear colleagues and students, ladies and gentlemen. It is truly a great honor to give a lecture named after a man who has left his intellectual footprint on so many of us. And in fact, as you will see from my lecture, I'm certainly one of them. Charles is one of the few people who can truly bridge the gap between theory and practice in monetary policy, drawing on his deep institutional and historical knowledge. For decades, his work at the Bank of England and here at the LSE has shaped not only how we conceptualize monetary policy, but also how we implement it. In my remarks this evening, I intended to honor that legacy by addressing a challenge that lies at the core of Charles's work and continues to occupy him, as you can see from his excellent new book entitled The Unanchored Central Banker. And the challenge that I'm going to talk about this evening is central bank independence. I think it's fair to say central bank independence is at risk. This was the key message conveyed by Jay Powell at his final press conference, explicitly referring to the legal attacks on the Federal Reserve. That a sitting Fed chair felt compelled to make such a statement publicly says something about the times we are in. Political attacks on central bank independence are deeply disconcerting. They risk doing lasting damage by sowing doubt about the institution's ability to act free of political consideration, weakening the anchor underpinning long-term inflation expectations. What makes the current moment particularly concerning is that direct political pressure is not arriving in isolation. It comes on top of structural forces that are quietly eroding the conditions under which independent monetary policy is effective. And two of these forces will be the focus of my remarks this evening. The first is the sustained increase in government debt to levels that risk creating a tension between price stability and fiscal sustainability, giving rise to fiscal dominance. The second is the renewed momentum towards financial deregulation, which, by reducing the resilience of the financial system, can create the conditions for financial dominance. The implicit need to prioritize financial stability over price stability. And I will argue that preserving central bank independence rests not only on sound legal foundations, but also on robust fiscal and regulatory frameworks that secure both debt sustainability and financial stability, as well as on a clear commitment by central banks to operate within the boundaries of their mandate. The broad acknowledgement of the importance of central bank independence for economic stability has been one of the most significant shifts in economic governance over the past 4 decades. By the turn of the millennium, independence had become the norm in advanced economies and was spreading rapidly through the emerging world as well. Its intellectual foundations were forged in response to the great inflation of the 1970s, which exposed the time inconsistency problem of monetary policy. Even well-intentioned policymakers attempted to exploit short-term trade-offs, leaving the economy with higher inflation and no lasting output gains. And the solution to this was institutional. monetary policy was to be depoliticized and delegated to an independent authority, one that is deliberately more inflation averse or conservative than society at large. And it should be guided by a clear, legally protected price stability mandate. The legal implementation and practical application of this solution was far from uniform, as differences emerged across countries regarding the design and the extent of central bank autonomy. In this landscape, the ECB stands out as one of the most independent central banks in the world. Its autonomy is uniquely fortified by an international treaty, and its institutional strength is bolstered by a political culture that recognizes the importance of central bank credibility for economic stability. The following decades vindicated this institutional solution in the euro area and elsewhere. And you can see this on my first slide. Central bank independence helped anchor inflation expectations. Inflation fell and stayed low across advanced economies. At the same time, output and inflation volatility declined in what became known as the Great Moderation. This improvement in outcomes, however, was not down to better monetary institutions alone. From a price stability perspective, macroeconomic conditions in the period from 1990 to 2019 markedly diverged from those that had prevailed before. From the 1990s onwards, rapid globalization and the growing role of China in particular expanded the global supply of labor and goods and intensified import competition, generating persistent disinflation. So in their attempt to control inflation, central banks were largely pushing on an open door. Maintaining price stability in such an environment did not test institutional resolve in the way envisaged in the 1970s and 1980s. And the challenge of the 2010s was actually the opposite, to lift rather than constrain or restrain inflation. And that task also required resolve, but of a different kind, namely the willingness to deploy unconventional and often controversial instruments, such as large-scale asset purchases, to defend price stability from below. Persistent disinflation also mitigated the tension between price stability and fiscal sustainability, as shown on this slide. Before the pandemic, historically low interest rates gave governments substantial leeway. In the euro area, for example, sovereign interest payments as a share of GDP, that is the blue line on the right-hand side, fell by half between 2012 and 2020. So, when inflation surged across the world in 2021, the key question was whether independent central banks had the courage to tighten policy even when higher interest rates could push the economy into renewed recession and worsen fiscal metrics by raising debt servicing costs. And the verdict is clear. Central banks did act decisively, reflecting what independence was designed to deliver: the capacity to prioritize long-term price stability over short-term economic and political gains. This was true regardless of their concrete mandates, as central banks with a dual mandate also prioritized price stability when it came under threat. A second question was whether the credibility that central banks had earned over previous decades could reduce the need for aggressive tightening by anchoring inflation expectations and preventing wage price dynamics from spiraling. And the answer was reassuring. As you can see on the left-hand side, in many countries, long-term inflation expectations remained broadly anchored, reducing inflation persistence and thereby compressing the sacrifice ratio, the output cost per unit of inflation reduction. And on the right-hand side chart, you can see that across a sample of advanced economies, the sacrifice ratio during the most recent tightening cycle was a fraction of what it had been in earlier tightening cycles. The contrast with the 1970s is striking. Back then, unanchored inflation expectations turned the supply shock into a wage price spiral, requiring a deep recession to break it. This time, central bank credibility allowed for a soft landing. But this episode also revealed the challenges independent central banks can face as the environment becomes more demanding. The left-hand chart shows that in the summer of 2022, markets sharply repriced monetary policy expectations in the euro area in response to the surge in inflation and started to move in a disorderly fashion. The ECB then launched the Transmission Protection Instrument, in short, TPI. When uncertainty is elevated, self-reinforcing dynamics can emerge that disrupt price discovery. The right-hand chart illustrates that in a currency union, markets are more vulnerable to such dynamics as country-specific risks may lead to fragmentation. And this was clearly visible in the aftermath of the pandemic, and then again when policy started tightening. The TPI was designed to address such vulnerabilities, countering unwarranted and disorderly dynamics that impair market functioning and hinder the smooth transmission of monetary policy. And to mitigate moral hazard, the TPI sets clear conditions for the purchases of sovereign bonds, ensuring that the instrument is only used in countries that pursue sound and sustainable fiscal and macroeconomic policies. By reducing the risk of fragmentation, the announcement of the TPI created the conditions for the ECB to increase rates to the extent needed to ensure price stability, thereby shielding and reinforcing its independence. The Bank of England's intervention in September 2022 served the same purpose: to restore market functioning at times of sudden disruption without compromising the monetary policy stance. The pandemic episode was, hence, a testament to monetary dominance. It underscored the strength of an institutional framework anchored in the primacy of price stability. Today, intensifying geopolitical tensions are creating a new and equally demanding environment for central banks. Rising tariffs and export controls, heightened geostrategic rivalry, and threats to territorial integrity reshape global trade and production structures. Together, these forces have exposed choke points in the global economy, rooted in dependency built up over decades of deepening globalization, which has given rise to a more fragmented and less predictable supply environment that makes the trade-offs inherent in monetary policy more acute and more visible. The energy price shock caused by the war in Iran illustrates the dilemma. The left-hand chart shows that even as the terms of trade shock depresses demand, a rapidly growing share of European manufacturing firms are planning to increase prices to protect their profit margins from rising input costs. This is the blue line. At the same time, signs of supply chain disruptions are re-emerging, the yellow line. The right-hand chart illustrates that inflation expectations of households are also adapting rapidly. In March, The median euro area consumer, this is the solid blue line, expected inflation 3 years ahead to be at 3%, a level similar to that observed in 2021 to 2022, while mean expectations, the dashed line, reached an all-time high. These developments suggest that price shocks are likely to feed through the economy faster than in 2021, as memories of that painful inflation episode are still fresh. As a consequence, investors in financial markets have reappraised the outlook for monetary policy. This has contributed to keeping market-based longer-term inflation expectations anchored around our 2% target, a testament to the ECB's credibility. If the energy price shock broadens, monetary policy will need to tighten to contain the risk of second-round effects threatening medium-term price stability. This risk has increased in recent weeks. As such, adverse supply-side shocks are likely to become more frequent. It is imperative that the inheritance from the pandemic era, the ability of central banks to tighten when the mandate so requires, is guarded carefully. Over time, this capacity may face increasing pressure from two potential sources: fiscal dominance and financial dominance, either of which could, under certain conditions, narrow the room for policy action in the future. Over the past 2 decades, sovereign debt has been rising measurably in response to a sequence of large shocks, such as the global financial crisis and the pandemic. The left-hand chart shows that across advanced economies, it is now at or close to post-Second World War highs, and structural forces are likely to push it even higher. Rapidly aging populations will significantly raise spending on pensions, healthcare, and long-term care, while shrinking the labor force that generates the tax base and weighing on potential growth. Illustrative simulations, which you can see on the right-hand side, suggest that the impact of aging on the public debt to GDP ratio in the euro area could be over 30 percentage points by 2050. This is the difference between the blue and the yellow lines. These demographic headwinds are at the core of the new book by Charles and his co-author Manoj Pradhan. At the same time, defense spending is rising sharply across NATO members, and the investment needs of the green and digital transitions add further pressure on public finances, amplified by rising interest burdens. What makes this fiscal outlook particularly concerning is not simply the scale of these spending pressures, but the growing difficulty of counteracting them. Rising political polarization and an aging median voter mean that assembling the majorities required for meaningful consolidation and future-oriented policies may now be harder than at any point in the post-war period. As a result, the scale of the fiscal challenge ahead is substantial. Private investors will need to absorb very large quantities of government bonds at levels rarely seen in recent decades. The fiscal outlook of the world's 2 largest economies make this evident. The IMF projects government debt in China to rise to 127% of GDP in 2031, up from 99% in 2025. For the United States, it projects an increase to 142%, up from 124% over the same period. And these volumes are not only a matter of price, that is the yield that clears the market, but also of whether private investors have the structural capacity to absorb sovereign issuance of this magnitude. That concern is heightened by a structural shift in who holds and intermediates the debt. By early 2025, hedge funds' share of secondary market trading had increased to around 1/3 in the market for US treasuries and to even higher levels in that for euro area sovereign bonds. This shift towards price-sensitive investors has made the demand for long-duration sovereign debt less reliable, in part explaining the stronger rise at the long end of yield curves. The left-hand chart of my next slide shows that many governments have responded to the changing interest rate environment by significantly shortening the average maturity of the debt that they issue. In the United States, for example, the share of treasury bills in total gross borrowing increased from an average of 42% in the 5 years preceding the pandemic to nearly 60% in 2025. The blue line in the right-hand chart illustrates that a monetary policy shock has a much larger and more immediate impact on the debt to GDP ratio when debt is of a shorter maturity. This means that the fiscal consequences of monetary tightening are now being felt faster and more acutely. The insulation that longer average maturities once provided is being progressively eroded. In this environment, the unpleasant arithmetic of debt sustainability can change in ways that matter for monetary policy. If fiscal policy behaves irresponsibly, monetary policy may eventually be forced to monetize government debt, giving rise to fiscal dominance. For example, the left-hand chart suggests that in some economies, stabilizing debt over the next 7 years would require primary balance adjustment of as large as 5% of GDP. These are the blue bars. History suggests that such adjustments have rarely materialized across advanced economies. These are the red bars. Should doubts about fiscal trajectories intensify, sovereign term premia, which have already increased significantly compared with the low rate era as shown on the right-hand side, could rise further. This could impose constraints on monetary policy, as higher policy rates could threaten fiscal sustainability. Fiscal vulnerability is not the only risk to central bank independence. It is compounded by a second structural development: renewed pressure for financial deregulation. Financial dominance arises when the fragility of the financial system effectively constrains the central bank's ability to preserve price stability. A central bank that cannot raise rates without risking financial disturbances or a financial crisis is not free to fulfill its price stability mandate. Financial fragility also amplifies fiscal dominance by increasing the likelihood of bailouts and public guarantees, thereby further weakening the government's debt position. The post-2008 regulatory reforms in the financial sector were motivated by the need to protect taxpayers from the devastating fiscal, economic, and social costs of the financial crisis. But those reforms, the impact of which is illustrated on this slide, also helped safeguard central bank independence. Higher capital requirements, tighter liquidity standards, and stronger resolution frameworks have reduced the risk that monetary tightening could trigger systemic instability, thereby easing the financial dominance constraint on monetary policy. And the post-pandemic tightening cycle was a remarkable vindication of this mechanism. One of the sharpest tightening cycles in modern history, after a long period of low or even negative interest rates, was absorbed with striking resilience. While there were some failures, primarily reflecting exposure to excessive interest rate risk, non-viable business models, and fragile funding, these were largely idiosyncratic rather than systemic. The core of the system, major banks and funding markets, held. That outcome reflected a decade of regulatory work and supervisory stringency. It also gives central banks the freedom to continue tightening even as stress emerged, illustrated by the ECB's decision to raise interest rates at the height of the market stress surrounding the failure of Credit Suisse. The current push for financial deregulation must also be assessed against this backdrop. Excessive deregulation could not only destabilize the financial sector, but also harm central bank independence. That being said, a periodic review of what has and what has not worked is, of course, legitimate and necessary for a framework now in place for over a decade. For example, one issue deserving inspection is the usability of buffers. Many banks hold high-quality liquid assets well above prudential requirements, suggesting they may be reluctant to draw them down in periods of stress for fear of signaling weakness, as was observed during the pandemic. A buffer that cannot be used is not fully serving its purpose, like in Charles's famous example of the last taxi that never leaves the station. A similar issue can arise with regard to counter-cyclical capital buffers, which may induce excessive deleveraging in crisis times, giving rise to a credit crunch. There's also a legitimate case for simplification. Frameworks accumulated over successive reform rounds can develop inconsistencies and high compliance costs. The ECB has recently undertaken exactly this kind of exercise, offering concrete proposals to cut undue complexity while preserving the resilience and adhering to internationally agreed standards. By contrast, lowering capital requirements or relaxing liquidity standards to the point where the resilience of financial institutions is called into question risks reintroducing the fragility that the post-2008 framework was designed to eliminate. And this, in turn, would widen the range of conditions under which a future tightening cycle could trigger systemic instability, thereby hampering monetary dominance. The threats of fiscal and financial dominance are not inevitable. They can be mitigated through policy choices made by governments, regulators, and central banks themselves. The path to reducing fiscal dominance starts with the composition of public expenditure. High and rising debt is not equally damaging under all circumstances. Redirecting spending towards infrastructure, education, and the green and digital transitions raises potential growth and puts debt on a more solid footing. Rising defense spending can also channel resources into research-intensive sectors, build human capital in frontier technologies, and boost productivity growth. Ultimately, however, more efficient spending alone will not do the job. A credible path for the consolidation of public finances is required. Fiscal rules must be enforced, not suspended in the face of every shock. The war in Iran is a case in point. The fiscal response to the crisis must be targeted, temporary, and tailored in the form of measures designed to protect the most vulnerable households and firms without significantly adding to aggregate demand and distorting price signals. In a world of more frequent supply shocks, fiscal policy needs to preserve space and remain aligned with monetary policy. Otherwise, central banks may be forced to tighten more forcefully, raising the overall cost to society. The agenda for protecting against financial dominance is straightforward. Preserve the resilience delivered by the post-2008 regulatory reforms and extend it to underregulated sectors. Since the global financial crisis, the financial sector has undergone significant structural shifts. Non-bank financial intermediaries now perform many functions that were previously undertaken by banks, but without the capital requirements, liquidity buffers, and resolution frameworks that make failures manageable. Private credit offers a telling illustration of both the scale of this migration and the risks it may create. The left-hand chart shows that in the United States, private funds now provide a substantial amount of credit, often to riskier and more leveraged borrowers. And the sector has been growing rapidly in the euro area as well, albeit from small levels. When investors in business development companies recently sought to withdraw their money and hit redemption limits, liquidity concerns quickly fed back into broader concerns about the solidity of the entire asset class. This can be seen in the marked drop in the valuations of business development companies, the blue line in the right-hand chart. These vulnerabilities were compounded by the opacity of the sector and its strong concentration in software businesses, the valuations of which fell by even more, as shown by the yellow line. Stablecoins add another dimension. This slide shows that today, stablecoin issuers are among the largest holders of US Treasury bills. Large-scale private issuers holding significant volumes of Treasury bills, bank deposits, or other assets could become a source of systemic stress, giving rise to runs and fire sale dynamics that may destabilize markets and the traditional financial sector. The next phase of regulation should focus on the same risk, same rules principle to avoid regulatory arbitrage. This would help prevent the financial dominance constraint from simply migrating from regulated sectors as the boundary shifts. Preserving independence is, however, not solely a matter for governments and regulators. Central banks must do their part as well. Two criticisms deserve consideration. The first relates to the blurring of the boundary between monetary and fiscal policy. Asset purchases are a case in point. The experience of the past 15 years suggests that the rationale for different types of asset purchases is not equally compelling. When used to address acute market dysfunction, asset purchases can effectively reduce systemic stress and prevent broader fire sales. The benefits of these interventions for society at large are widely acknowledged. The case is less straightforward when central banks deploy asset purchases to provide additional monetary accommodation when policy rates have reached their effective lower bound. The macroeconomic benefit in terms of raising inflation towards the target have shown to be state-dependent, and they generally diminish as the stock of acquired assets grows. By contrast, the costs and side effects of asset purchases have become increasingly visible. Interest rate risks translated into taxpayer losses when policy rates rose, safe asset scarcity threatened market functioning, and risk was mispriced across asset classes with politically salient distributional consequences. The fact that such costs did not deter central banks from tightening policy serves as a clear demonstration of monetary dominance in action. But the fiscal consequences of asset purchases inevitably expose central banks to political scrutiny and distributional debates. Therefore, the bar for deploying asset purchases as a stimulus instrument should be higher in the future, and their use should be more targeted and parsimonious. The second criticism concerns the allegation of mission creep, in particular regarding central banks' engagement with climate change. Over the past decade, several central banks, and this includes the ECB, have emphasized the urgency of advancing the green transition and of greening the financial system. The ECB has also started greening some of its own operations, for example, by tilting corporate bond purchases away from emission-intensive companies and by incorporating a climate factor in its collateral framework. Much of the pushback this has generated can be attributed to misinterpretation. Central banks' action on climate are not about pursuing policies reserved for governments. Central banks are not climate policy makers. Rather, the engagement is at the heart of their primary mandates. My final slide shows that climate change is already affecting the inflation outlook. More frequent floods, heat waves, and droughts have lowered agricultural yields, disrupted supply, and damaged infrastructure, all of which feeds directly into price dynamics. The 2025 heat wave, for example, had a measurable impact on food price inflation, and estimates suggest that even in an optimistic scenario, future heat waves will continue to put sizable upward pressure on food price inflation. Climate change also creates significant risks for financial stability. Stranded assets, repricing of climate-exposed collateral, and abrupt transitions can generate correlated portfolio losses. Hence, considering the consequences of climate change for price and financial stability lies at the core of central banks' and supervisors' mandate. Let me conclude by returning where I began. Central bank independence was designed for a world in which the temptation to subordinate price stability to short-term economic or political gains is greatest. This is the world we are facing today. Inflation is once again rising measurably above target in response to yet another adverse supply-side shock. The ECB enters this challenging environment from a position of institutional strength based on a solid legal protection of its independence. And the Governing Council has made clear that it stands ready to do whatever is needed to bring inflation back to its 2% target over the medium term. Preserving that capacity in the future requires safeguarding central banks' room for maneuver from forces that risk constraining it. This requires governments to place public finances on a genuinely sustainable trajectory. It requires regulators to resist pressure to dismantle the post-2008 financial architecture. And it also requires discipline on the side of central banks to firmly remain within their mandates. The alternative, allowing fiscal and financial dominance to quietly erode the space for monetary policy amid blurred mandates, would progressively hollow out independence and ultimately lead to higher inflation and lower growth. Central bank independence is not a technocratic preference. It is a commitment to protect the value of money for everyone. Thank you very much for your attention.
Okay, thank you very much, Isabel, for this fascinating lecture. We've now got time for Q&A. I'm just going to say a few words about how we will handle the Q&A. So we'll open the floor for questions. When we do that, if you do have a question, please raise your hand. And then, very important, please wait for the microphone to arrive. We've got people passing out the microphones both down here and up on the balcony. So wait for the microphone so everybody can hear the question, please. When you ask a question, please let us know your name and affiliation. And of course, we're always particularly keen to hear from our students and alumni. But of course, everybody can ask questions. The way we're going to do it, I think, is we're going to just collect a few questions. So we'll collect 3 questions, then we'll give Isabel a chance to answer, then we'll collect another round, and so on. And of course, as you might expect, questions like what will happen at the next interest rate setting meeting at the ECB will likely not get an answer, although you can try. But in any case, let's do the first round of questions or hands up. Okay, let's start the blue jumper in the middle right there.
Hi, hello. Thank you very much for the lecture. My name is Filippo, and I'm a master's student here at the LSE. You argued that high public debt can create fiscal dominance and that financial fragility can constrain central banks, but could a similar problem arise in macroprudential policy? For example, in a high indebted country, might authorities, who are also usually not independent, be less willing to activate tools like the countercyclical capital buffers you mentioned, if they fear that it could sort of tighten credit conditions and add pressure to the sort of sovereign-bank relationship?
Let's collect a couple. Yes, up there on the balcony, second row.
Thank you for a great talk. I just want to ask, how do you explain this disconnect
Can you
between
speak
what's
Into the microphone, please.
Very
Yeah, how do you explain the disconnect between what's happening on the supply chain and the inflation side and the stock markets? They're hitting record highs while we see all disruptions on the supply chain and also on inflation. How do you explain this disconnect? Thank you.
On the left-hand side, on the balcony, please.
Hi, thank you for your lecture. My name is Adhere from the Bank of England. Interested in understanding, you talked about stable coins, very interesting to see kind of the level of US Treasury holdings that stable coins have. What do you think the risks of sort of disintermediation are, particularly given the kind of way frameworks are evolving both in the UK, in the EU, and in the US? And is that an additional risk that central banks should be considering as part of their regulatory architecture for stablecoins?
Okay, yeah.
Over to you, Isabel.
Okay, so on the first question, I mean, first of all, I argued that policies that are meant to preserve financial stability are protecting central bank independence, right? And so in principle, of course, macroprudential policies are also part of that and are very important to protect the independence. If I understood you correctly, your concern is that the macroprudential policies may also be affected by political forces. And I mean, to be very honest, I mean, that is of course always a risk. And if you also look at how macroprudential policies are set up in many countries, there is often foreseen a certain role for politicians to be part of the decision process, and that can lead to a situation where the measures that are taken are maybe less than, let's say, a purely technocratic body would have taken. And this is why some people argue that there should be less political influence on macroprudential policies. And I personally have some sympathy for that. But of course, we have to be aware that macroprudential policies are highly political, especially also when it comes to things like, let's say, borrower-based measures and these kind of things. They are highly political, and and this is why there is some political influence there as well. So your question is of course an interesting one. So if you look at stock markets, indeed, if you just look at the stock markets, you could get the impression that nothing has really happened. So there really seems to be a kind of disconnect. And there are, of course, different explanations. I mean, one is that financial markets have the expectation that the conflict is going to be resolved very quickly and in a very painless way. And I mean, let's see what is going to happen. I mean, my personal view is that some of the damage has already been done, and therefore it's actually very hard to go back to the pre-war situation. Therefore one could question could ask whether markets are possibly a bit complacent here. But of course there are other issues. I mean, if you, for example, look at our models, which, like dividend discount models, which look at the drivers of equity prices, I mean, what you see is that one supporting factor of stock prices, and I think that's even more true in the United States, has been relatively strong earnings expectations. So there is something fundamental going on, which may also explain the strength of stock markets. And then finally, and there may be other factors, but the third that comes to my mind is that, of course, especially in the US, there is kind of a concurrent story, which is AI. And the question whether AI will kind of bring us into a completely new world with much higher productivity and so on. And of course, the jury is still out, but it seems that that investors are very, very optimistic about that. But I think what your question basically says is that there is a risk coming from these very high valuations, and that is also something that we take very seriously. And so on your question was, so it was about stable coins, but I don't know what precisely the question was. Can you maybe repeat just the...
Sure. I was asking in terms of disintermediation risks, so kind of the way stable coins are potentially disintermediating the role that banks play in terms of taking deposits. I think that's an area that's been highly discussed, obviously, in the US and in the UK as well. Interested in your view about sort of the euro area's perspective on that.
Yeah, so that's indeed, it's a very interesting and important point that is debated a lot in policy circles. I think when it comes to stable coins, it's very important to be precise, because stable coins differ with regard to many dimensions. I mean, one is the question of use cases. So what are the stable coins? I mean, at the moment, stable coins are still relatively small everywhere. I mean, they're a bit larger in the US, and it's basically used for crypto. So, but that is probably not what we are talking about. When we are talking about disintermediation, we are taking a more forward-looking perspective, and we ask ourselves, so what could stable coins be used for in the future? And so, of course, they could potentially be used as means of payment. They could potentially be used as store of value. They could potentially be used as settlement assets in a tokenized financial system. And the different use cases have kind of also different implications regarding the question how much disintermediation there is, and so basically what the stable coins are competing with, whether it's bank deposits, whether it's money market funds, whether it's even, I mean, cash. So when you think about the use of US dollar denominated stable coins in some emerging market economies, they may actually replace dollar cash. So that's one dimension that matters a lot. The second dimension that is very important is the question, what are the reserve assets of the stable coins? And I mean, broadly speaking, there are three different types of reserve assets. The one that is kind of most prominent in the United States is government paper, so short-term, I mean, basic treasury bills mainly, so short-term government paper. The second that plays a large role in the European regulation on stablecoins, MiCA, is bank deposits. And the third that could potentially become a reality, for example, in this country, is central bank reserves, right? And depending, again, whether there even is a disintermediation depends very much on what the stablecoin issuers actually invest in. So if the stablecoin issuer actually invests in bank deposits, there is not really a disintermediation. But of course, there's still a structural change in the banking sector, because a relatively stable retail deposit is replaced by a potentially very flighty wholesale deposit of a stablecoin issuer. And I mean, that has important implications. So the answer to your question is, it really
depends on the specific case that is embedded in the regulation, and that then also materializes in practice. And I think it's still very open. And it's not a given that there is a disintermediation, but what is a given is that there's a lot of change in the financial structure.
Okay, we're ready for another round of questions. Let's start here in the front.
You referred to two.
Could you please introduce yourself?
Patricia Jackson, Handelsbank. You referred to two problems that have arisen in recent years. One is the losses made by the central banks as they claw back the asset purchases by selling them. The second is the disintermediation into shadow banking. With the first, I wonder whether stronger risk departments inside the central banks, which had done stress testing of the balance sheets, as they were considering the asset purchases, would have led to more balance between the amount taken onto the balance sheets and the benefits. But without that stress testing highlighting the potential losses, you didn't get risk management and you didn't get that balance. On the second issue, the disintermediation, you have to consider the effects of Basel III. If the capital requirements in some areas are much higher than the risks, the banks will not hold them. They will move into environments where they're not meeting regulatory requirements.
Lady.
Hi, Natasha Postelvine from the LSE. There's a sense in which banks today, especially in the EU and in Britain, are a lot safer than they used to be before the crisis. The 2008 financial crisis. But in other ways, you showed a graph that showed how much non-bank credit had risen in the US, especially, a lot less in the EU, quite a lot in the US. My question is, do you think that EU banks and British banks are exposed or highly exposed to US non-bank credit?
Okay, and I think there were some hands somewhere there. Yes, right in the middle here.
Thank you. Frau Schnabel, you
could you also just mention your name? Thank you.
Stefan Güter, LSE Alarm. Frau Schnabel, you mentioned how central bank independence anchors inflation expectations. However, in the case, theoretical, of an oil price shock, how can central bank policy effectively counteract such an inflation shock when aggressively raising rates would stifle demand and lead to a stagflation scenario?
Okay.
Yes? Okay.
Yes.
So, again, very interesting question. So let me start with your questions. So the first point I would like to stress is that, of course, central banks have never seen themselves as kind of profit maximizing institutions. So there was always a kind of the view that the actions are determined primarily by our mandate, right? And there was the view, at the time, and of course there was a lot of scientific literature also supporting that it was the right thing to do the asset purchases, even if it was foreseeable that this could lead to losses later on. Maybe I would even go a step further. There's even a literature arguing that the fact that markets know that raising interest rates has kind of this effect on profits, that even made the commitment to remain relatively loose in monetary policy more credible, which seemed to be an important thing when interest rates, when inflation was low and below target. I mean, now, of course, with hindsight, some people say, well, was it really all that bad? I mean, in the end, inflation, I mean, of course, it was below 2%, but who cares about inflation below 2%, except for central bankers? Probably not so many people, and therefore, maybe the balance, so with hindsight, one would kind of shift the balance a little bit. And I mean, of course, I mean, these analyses have been done. I mean, we knew what would happen. I mean, we have, of course, the projections of our incomes and so on. The analysis has been done, but in the end, the decision is not taken on the basis of that, but on the basis of the monetary policy case. So then, your second question, it's also, I mean, a bit related to the next question. So I think it's by now relatively well established that the developments in private credit and other market segments are partly related to the stricter regulation introduced after the global financial crisis, in the sense that riskier business was pushed out of the banking sector because the view was that banks are not the ones who should bear these risks. But then, of course, one has to ask, so where do these risks end up? And in the end, when you design an overall financial regulation, you have to ask the question, who can best bear these risks without causing financial crises and systemic instability? And I mean, you kind of seem to suggest that maybe regulation went too far, and you created risks in the NDFI sector that are too large. And a different perspective could be, okay, it was desirable not to have these risks on banks' balance sheet, but of course there are also risks in the NDFI sector, and you need to have a proper regulation of that sector, which of course in the current geopolitical environment is not easy, because the trend goes only towards deregulation and not towards further regulation of underregulated sectors. But I mean, this is the kind of debate one would need to have in order to answer your question. So your question. I mean, that's so. First of all, the private credit segment still remains relatively small, but it's growing rapidly. In Europe, the amounts are at the moment so small that they cannot, I mean, they can, but they're unlikely to give rise to systemic risk now. Of course, when they grow further, that's a different question. And so your question is very much on point. In the sense that if we look from a European perspective, one should ask whether risks could spill over from the US to the European banks, as we've also seen it, of course, in the global financial crisis. So our analyses so far show that the exposures are still relatively limited, so that this is not kind of an acute fear. But everybody, as you know, is looking very carefully at this market segment. And I mean, I would say that it's not sufficient to say that this is not large enough to pose systemic risks. If we think that if it grows, it could pose a systemic risk, we should now think about what needs to be done. I mean, one obvious point is greater transparency. So the visibility is very low. I mean, we really don't see the data. And even if we see like direct exposures, we of course know very little. I mean, it could be indirect exposures that also the supervisors have a hard time to assess. And so I think that is something that is a first step, that we get better data, because only then we will also be able to better understand the risks that are building up. And then of course the question then comes: so what are the risks? I mean, do we have Is it mainly a problem of illiquidity? Is it a problem of hidden leverage? I mean, so these are exactly the questions that we have to ask, and often we then say, we don't really know, we don't have the data, and that's a problem. So, who had the third question again? Yeah, right, sorry. So that's of course exactly what we are talking about now. So if you have kind of let's say a textbook supply side shock that is temporary, I mean, the prescription would be, okay, we cannot do anything about the immediate rise in inflation. I mean, there's nothing we can do. Our instruments are only effective with a lag, and in any case, what can we do about global oil markets and geopolitical disturbances? And so then the prescription would be to look through the shock, because if we acted, then we would basically impose a cost, as you said, a cost on the economy by dampening the economy, and the shock would basically already be over when our tools become effective, and then that would not be an optimal policy response. Of course, reality is often more complicated. But in fact, one of the key questions that we now have to ask ourselves is whether this energy price shock kind of remains more or less constrained to the energy price shock, or whether it significantly broadens to other parts of the economy. And this is why what we look at in order to also assess whether a monetary policy response is needed is we look at indirect and second round effects. So the question, how does this energy price shock that we can do very little about, how does this kind of work its way through the economy? And so there are different aspects that are important. I mean, one is, many firms experience an increase in their costs. Are they going to pass through this increase in their costs to consumer prices? And then your argument comes in. This depends very much on how strong aggregate demand actually is. I mean, if the economy already entered a recession, let's say, it's actually the pricing power of the firms will be relatively limited, and the ability to pass through the prices, the higher cost to the prices will be limited, and that could mean that a policy response is not needed. Another point that needs to be looked at is what happens to inflation expectations and what happens then to wage setting. And there again, whether we are going to see, people will experience, even if it just stays within energy, will experience a loss in their purchasing power. And so employees are going to try to negotiate for higher wages. To what extent they can be successful in that, again, depends on how strong the economy is. And this is also then where monetary policy comes in. Because if we see that actually that the higher costs are being passed through and that the wages do increase, that is then the sign that monetary policy has to react, not only to send a signal, but actually to constrain aggregate demand by making it harder to pass through the higher costs and to negotiate higher wages in the end. And so this is a difficult debate that we have. I mean, what we see is, of course, we see a sharp rise in energy prices, but what we also see, and this is something that is concerning for us as central bankers, is that inflation expectation, I showed it on the slides, inflation expectations have gone up quite a bit, selling price expectations have gone up quite a bit. Wage growth, not yet, but that is, of course, something that always comes with a lag. If we wait for that to materialize, we will, in any case, be too late. And so we have to take a stand on whether the dampening of the aggregate demand is strong enough to prevent the price pressure from broadening beyond energy prices. I mean, that's a bit the way well, at least I think about it. Sorry for the long response.
Great. We have time for a few more questions. Let's go first to the balcony again. Let's see, right front row on the balcony.
Hi, I'm Baudi, master student at LSE, and I have a question. So during 2022, there was a war which led to an energy crisis, and the ECB at that moment, a bit later, increased interest rates, but that also led to a reduction in green investment at a time when it was maybe most needed. So during your presentation, you mentioned that the ECB is not a climate policy maker, but maybe with my example, I would argue the exact opposite. So does the ECB take this into account, how interest rates impact green transition and green investment, especially now that we're in an energy crisis again? Thank you.
Yes, on the right. Yep.
Thank you, Martin Wheel from King's College. I think you didn't say anything about financial repression as a way of alleviating our current problems. If you had to choose between financial repression and inflation, which would you choose, please?
And then first row here on the right. Yeah.
Hi, thank you. I'm George, member of the public. If the central bank can only set...
Speak into the microphone, please, otherwise it's hard to hear.
If the central bank can only set the short-term rates, why, and the long-term rates are set by the market, why does the political class are pushing for the lower rates? Because markets will respond in it. And a second question would be, what's your view regarding the potential yield curve control for the Fed, for example, from the perspective of independence? Thank you.
Isabel.
Okay, so it becomes more and more complicated.
Yeah.
So, okay, so it's. I mean, I mentioned the debate about our role in climate change because there was so much criticism about it, and I mean one of the arguments that was made is that, you know, thinking about climate change distracts us from our primary mandate. And if that were the case, that would be very harmful. So in a situation where inflation is moving to double-digit numbers, a central bank cannot not raise interest rates because of these longer-term considerations. I mean, that would be something that would not be in line with the urgency that comes from this sharp rise in inflation. I mean, in fact, I mean, there was a debate at the time that some people were arguing that that we were holding up the green transition. But of course, I mean, if you take this argument to the extreme, I mean, we could never raise interest rates, right? And that is, I think, that is not how central banks can operate. I mean, there is now an interesting debate about not only with regard to climate change, but more generally, whether central banks in setting interest rates should take into account the impact that that the policy has on investment and on longer-term growth and so on. I mean, this I think this has not been really decided, but in the practice of central banks, this is nothing that is really done. But the debate is there, but not to the point that it has kind of affected the policy making. So I'm not sure I have an answer to your question. I mean, I'm responsible for inflation. I'm not responsible for financial repression. That's so. What I can do is I control inflation, and I hope there's not going to be financial repression. So who had the last question again? Oh yeah, it was you. Okay, so your question was, I assume you say governments are to a large extent financed longer term? And so why are they pushing for, so first of all, there is of course a certain transmission from the short-term rate to the long-term rate. I mean, we don't control the long-term rates to the same degree simply because there are many other things, term premium and so on. But in the end, of course, one part of the long-term rate is expected short-term rates, right? And so this is a part. So there is a transmission, of course, to longer rates. But I also showed that there has been this shift, remarkable shift towards shorter maturities. And that, of course, then creates a much more direct link between government finances and monetary policy rate setting. Because then you have the immediate transmission, which I think also then poses a risk. And yield curve control. If you want to know about the Fed, you have to ask the Fed. So we have decided against yield curve control, but this is maybe that's a too big debate to have in this circle.
Very good. I know there are more hands up, but we also have a really nice drinks reception that we're looking forward to outside. So everybody is warmly invited to join us, and the stewards will show you exactly where to go, but it's just outside here in this building. Before we go there, first of all, I want to thank all of you for joining us. It's really been a great pleasure, and in particular to have the opportunity, for me and I'm sure all of you, to listen to Isabel's lecture and then also engage in this very stimulating Q&A that we just had. So let's please give a big round of applause to Isabel.